The FOMC meeting this week, economists are expecting another rate hike of 25 basis points. Officials signaled 2 more hikes this year at last month's meeting. The question is how quickly the next hike will come, or will it? Here with a closer look, we've got Hugh Roberts, Quant Insight Head of Analytics. Hugh, how hawkish do you expect the Fed chair to be in this upcoming meeting?
You want to kind of try and find an outlier statement to be a little bit different from the consensus, but I can't disagree with anything that you guys said at the top of the program or that Jen's just given there. You have to think the most important thing for Chair Powell will be to keep the options of rate hikes alive. So he will be determined not to give any kind of green light to markets to allow them to run away with an easing of financial conditions. So he might not be uber hawkish, but I think it'll be very much about optionality, keeping the Fed data dependent, and not trying really hard not to pay any lip service to peak rates and a reversal of any kind of dovish pivot.
Hugh, do you think the Fed can pull off a soft landing if, in fact, they do continue to raise interest rates through the end of the year?
Yeah, the million-dollar question that everyone's obviously struggling with at the moment. History would suggest no. It's a tough act to pull that off during normal economic times. And I think what we've really learned this year is that the long and variable lags that we're all used to talking about when it comes to conventional monetary policy have been distorted even more by COVID and lockdowns. Now, even if you're one of those Wall Street strategists who's recently capitulated and moved their kind of year-end S&P 500 forecast higher, they're still on the whole looking for the market to come back down again. So the consensus is that these lags are still out there. They've just been distorted by COVID, and therefore I think one of the cliches out there is that the hard landing looks like a soft landing for the first couple of months until reality bites. And I think that's probably still the playbook for most investors.
In many ways, Hugh, the Jackson Hole Symposium next month gives the Fed, Jerome Powell and company, some breathing room to think beyond this current meeting and whether that second rate hike should come. What do you think the Fed should do beyond the July meeting based on the data that's come in so far?
So I think in a way, actually, it's less about rate hikes. Another 25 after this week, is that really going to make a big difference given the speed and the magnitude of the moves we've seen already? I think what markets will probably have more of an eye on is stuff like QE, the Treasury General Account, the spike in issuance that's coming for treasuries, and all that means for liquidity in the aggregate, as opposed to just focusing on Fed funds exclusively. It's a tough kind of needle to thread for the Fed. But I think, again, at Jackson Hole, you're absolutely right. Markets will be preoccupied with that over August. And I think, again, they will be trying to stress the fact that they want to try and enact a policy of normalization, try and shrink the balance sheet. They want to engage in QT rather than QE. They want to replenish the Treasury General Account. But they don't want to see another repeat of what we saw a few years ago in terms of the repo market jamming up and all the issues that caused the Treasury bond market and the spillovers into equities. So I think it will be kind of, again, options open, trying to normalize policy as much via balance sheet measures as it is via the Fed funds.
And one of the reasons we've seen consistent rate hikes is because Jerome Powell, he's been very adamant about reaching the Federal Reserve's inflation target of 2%. We've been talking to previous guests about whether or not that inflation target should be adjusted. Do you think it should? And what level should that be at?
Yeah, I mean, personally, I think it should be. There's no magic around 2%. But sadly, the timing is all wrong. This is definitely one of those narratives that you need to do it when you're coming from a position of strength. So, it's easy being a bit of a Monday morning quarterback, so I apologize, but, this should have been done sometime during the 2010, 2020 period. Not doing it when you're coming back down. And, you've had the low-hanging fruit of base effects for the first 6 months of this year. Improvements in headline CPI are going to be increasingly hard work going forward. Core CPI should still edge lower over the next few months. But to start tinkering with the inflation target when you're traveling from north to south, I would argue the optics is not good, especially when you look at the fiscal situation and the amount of bonds they've got to sell. So I know that's not the Treasury, that's not the Fed's concern, that's a Treasury concern, but you got to look at it holistically. So I think that we're not going to get anything on that anytime soon in terms of a target change.
Yeah, probably not good timing in the middle of a tightening cycle there. Let's talk about earnings season. We've got it kicking into high gear this week as traders eagerly await to hear from Microsoft, Alphabet, and Meta after big tech stocks have driven much of the market's 2023 gains so far. Hugh, what's your expectation here? I mean, you could argue they have had such an incredible run up. It's hard to meet the expectations going into this earnings season, but could we start to see that tech trade unravel in a big way?
Yeah, so we've seen a little bit of unraveling already. Can it go further? Yeah, I mean, I guess it could. But the one thing I would say is Quant Insight, we're a macro shop. We have a kind of an AI-driven process that takes a load of macro variables and then looks at tech stocks, the Nasdaq, S&P, dollar crosses, etc. So there are far better people qualified than I to talk about individual stocks and the company fundamentals and earning projections. But I think you're absolutely right with one of your comments earlier that Tesla and Netflix and the price action around their results last week did feel a little bit like a canary in the coal mine, a warning that that they're not going to trade well with bad news, but given how lofty valuations are. The only thing I would say to counter that is that from our macro perspective, one, our models have got incredibly high confidence at the moment. The macro factors are doing a very good job of explaining all tech stocks. Nasdaq, XLK, XLC, Meta, Microsoft, all really, really high model confidence on Quant Insight. And actually, the correction we've seen already has done a lot of traveling on our metrics. They're almost back to fair value. So from our perspective, which, as I say, is a uniquely macro perspective, and this week's going to be all about bottom up and company news, I get that. But from a macro perspective, a fair amount of the unwind has happened already.
Hugh, what about growth versus value? We've seen growth stocks heavily outperform some of those value names. Do you anticipate any bounce back in value towards the back half of the year?
Yeah, so from a personal perspective, I think that makes complete sense. All the conversations you guys would have had about, the lack of breadth to the rally, and we need to see catch up. And if the market does start to get excited about the story that we can get a soft landing, then cyclicals make sense. And we've seen price action in the Dow and financials over the last couple of sessions, beginning of this week, end of last week, perform well. Yes, but again, coming back to our models, we look at everything from a macro perspective. And actually, while you've seen NASDAQ and tech come back towards model value, something like XLI is now starting to get a little bit rich versus the prevailing macro conditions. So it really hasn't taken much for cyclicals to start looking a little bit stretched on the upside and tech to get back to fair value. And that just reflects the fact that credit spreads are still tight, rate vol is still behaving itself, and economic growth is still motoring along quite nicely and being quite resilient. That's the macroeconomic reality, and they're the fundamentals our model's picking up on.
We've got the Dow currently looking to continue its winning streak while the S&P 500 enjoys gains of over 18%. That's so far this year. When you consider what's happening in the earnings picture, the macro landscape as well, what does your portfolio look like right now? To what extent are you shaking things up?
Yeah, so I think what you'd have to do is I don't think you can personally, I don't think you want to divest yourself completely of tech, even on these crazy lofty valuations. The reality is I think you have to think about these big AI plays as options really, rather than as a kind of traditional equities. You're really buying an option on the idea that this AI frenzy is a genuine game changer. And we are going to see a jump start higher in terms of company profitability, earnings, and everything else around it. So if you think about it in that metric, then lighten up for sure, given the run that we've had over the last few months, given the event risk around earnings this week. But total divestment, I think, would be an imprudent way to go, personally.
Should be an interesting week to see how things shake down. Hugh Roberts, Quant Insight, Head of Analytics. Good to talk to you today.
Thank you.